So today in this lesson we are going to discuss about the inventories. Inventories in the sense stocks, trading stocks, that is called trading stocks. Inventories, trading stocks. So we will see trading stocks in the sense the goods we are holding for the with the intention of the trading activities in the ordinary course of our business. That is the inventory. So we can see the inventories definition for the inventory as per the international accounting standards. Definition is inventories are assets. Okay, inventories are assets. Inventories are stocks are assets, that is falling under the current assets held for sale in the ordinary course of the business. Held, we are holding those stocks for the in the ordinary course of the business. We are holding that stocks in the ordinary course of business, right? Other factors used in the process of production for such sale. Used for the production of such sales. If we are involved in the manufacturing process, if you are involved in the manufacturing business, manufacturing, trading and profit and loss account we have to prepare. So manufacturing and trading activities, right? We cannot involve only in manufacturing, but the manufactured goods has to be sold, right? So we will have manufacturing and trading activities. In such activities, such goods should be used. That's what they are saying, used in the process of production of such sale. If we are involving in the trading activity, right? If we are involving in the trading activity, the goods needed to sell to the customers, those goods, right? We need the goods. Okay, goods we need the goods too for the purpose of sales. Okay, we need goods. These goods can be purchased 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 or manufactured. It can be either or neither. The goods we are going to sell, right? These goods, right? Sales means trading activity, right? Trading is called trading activity. Okay, goods, we for our trading activity we need goods. Trading activity in the sense sales. So for the goods, to obtain these goods we have to either purchase it or manufacture those goods, right? So purchased goods also comes into inventory, right? Manufactured goods also coming into the inventory. Okay, also coming into the inventory. Semi manufactured goods also coming into the inventory. At the end of the year, the uncompleted production goods, raw material, right? If it is a manufacturing, we may have raw material, raw material, raw material, and finished goods, semi finished, say semi finished goods and finished goods, right? The goods which are used for the sales can be purchased or can be manufactured. If it is purchased, only the finished goods will be there, or raw materials also you can. You are not going to further process that inventory. That may be your finished good, right? That is for your finished good. If you are not further processing with that particular goods purchased, that is the that is inventory for you, finished goods for you, right? The person who is going to manufacture using that goods which are sold by you, for him it is the raw material, because he is going to do the manufacturing process. He is not going to do further processing by adding values for that particular good. So for him it is the raw material, right? If at the end of the period there may be a semi finished goods, means the production would have been on the halfway, 50% may be completed, 80% may be completed, would have been completed. So those goods are specified by semi finished goods, semi finished goods, because it is on the halfway, it is not completed, the finishing process not completed for those products, for those inventories. So those inventories we used to call semi finished goods. Finished goods in the sense 100% we have completed. We have completed the production process, means that is finished goods. So these are the goods we used to have in the possession of inventory. Inventory. Inventory can be finished good or raw material or semi-finished goods. That is depends on your nature of the business. So that is what we are talking here. Inventories are assets held for sale in the ordinary course of business. In the ordinary course of business, always remember that this should be carried out in the ordinary course of the business, these sales, used in the process of production of such sale, used for production of such sales, that is the manufacturing. Production means manufacturing, so that can be used for raw material or semi-finished or like that. And third fact is in the form of materials, that is materials, raw materials, supplies to be consumed in the production process or in the rendering services, can be in rendering services. That is what we used to say, raw materials and maybe oils and any other services to produce. If you are hiring some services from outside for in the process of a manufacturing, that's the rendering services, right? In the process of the production, right? In the rendering services. right? Consumables means oil, petrol, those are the consumables, right, in the course of the production. Electricity also consumable, right? Other thing is simply stock held by the entity. Inventory could consist of, right, the inventory could consist of goods purchased for sales. That's what I have mentioned, goods purchased, right, either purchased or manufactured. Goods purchased for the sales. Consumable stores, that so consumables such as oil, I told you earlier. Raw materials, that's what I'm mentioning. If it is your business is manufacturing, you may have in your stock raw materials, components, right? Partly finished goods also we used to say semi finished goods, right? Semi finished goods, that is the partly finished goods. And finally the finished goods, finally the 100% finished goods. Partly finished goods in the sense it may be 20% completed, 10% completed. It is between the 0 to 99%, that is semi finished goods, right? Finished goods in the sense 100% manufacturing process is complete. There's no need for any other further additional processing for those goods. Okay, understood? If you understand up to this level, okay. Okay, so this is the trading goods, right? You would have understood what is the stocks, right? How the stocks can be identified. You understood. Next is, the following are the main provision of the IAS 02. These are the main provision of international accepted accounting standards. That is international accounting standard, IAS, right? One, the inventory should always valued at the lower of cost and net realizable value, right? That's what I told you. The inventories should always valued at the lower of cost and net realizable value. Here we used to say measurement of inventories. Measurement of inventories, right? Measurement rule is inventories should be valued at, right? Measurement rule is inventories, right? This is the measurement rule, right? Inventories, it's the measurement rule. Here measurement rule is says inventories should be valued at lower of cost or net realizable value. Cost or net realizable value. Cost of the product or net realizable value. What is cost and other expenses, selling expenses or any other things we had to do. The cost of the inventory should include all the cost of purchases, of conversion and other costs incurred in bringing the inventories to the present or current location and condition, right? The cost in the sense the purchase cost involved and, right, the cost is purchase cost involved and any other cost involved in bringing that particular goods or inventory to the current location or present location and condition, right? Current location and present location. right? And condition. Inventories, you say we have purchased, purchasing cost is mean 500 rupees. Purchasing cost of, we'll say purchasing cost, okay, otherwise it is completing for you complication. Here we say purchasing cost is 500,000, 500 rupees. This purchasing 500,000 we'll say, okay, no, I will say unit price, right? Unit purchasing cost, unit. We had to calculate the costing for per unit of product for the 1 unit of the product, right? Not the whole purchases. Okay. Unit purchasing cost is 500, right? Then now it is in you know, you think it is on uh, the place where we have bought is in different location, location A, right? Location A, right? A, right? We are in location D. We are in location D, right? So we are purchasing at the location of A, location A, and we have to bring that goods to the location D, right? So to bring that particular goods from location A to D, maybe cost may be involved. Cost may be involved. Understand? Because we have purchased that goods from outside, right? We had to bring that goods to our warehouse, our business entity purchasing the goods. So we had to bring it inside the business entity, no? So there may be a cost involved to bring that to our business. So the cost is involved, maybe transport, we can say transport, maybe we say 10 rupees per unit we involved. So that has to be added to the 500 purchase. That's what they say. Inventories should be valued at lower of cost. Cost means the cost of the inventories should be included all the cost of purchases we have involved, we have calculated. Cost of conversion, cost of conversion still we didn't say, right? And other cost included in bringing the inventories to the present location and condition. Cost of conversion and all other costs. All other costs means this transport and other things to bring that cost and labor, right? Loading and unloading, labor also you say 5, cost per unit is 5, right? We brought this into the our business, right? After bringing that product, we say uh, we are making some small modification in that product. Sorry, we make a modification small modification in that product, right? That means we are putting a color, or we are putting one sticker, branding sticker, or some modifications, right, to that product. Means some sort of modification. So for that modification we involve a cost of 50 rupees, small modification cost, or we can say value addition. That cost also we had to say add it to the cost. So now the product is inside our location and inside our warehouse. So this cost we have involved before selling this product. So these costs has to be added to the purchase cost. So that is what 565. This is the actual cost of the production. Actual cost incurred. This is the actual cost incurred. This is what the accounting standards, international accounting standards says the cost of the inventories should be include all the cost of purchases included, cost of conversion 50 rupees we have included, and other costs incurred in bringing that inventories to their present condition and location, and present location and condition, right? Current location and condition. That is what we are involved in. Transport charges, we are involved labor charges, we have added. Now this is the actual cost per unit of the goods stock. Okay, this is the, that is what we have mentioned here, right? The cost of the inventory should include all cost of purchases, cost of conversion, and other costs incurred in bringing the inventories to their present location and condition. Over, right? Overhead expenses be excluded from costs. Right? Overhead expenses should be excluded on the cost, right? That is selling cost, selling cost we are not considering in the cost of the unit. And storage, once you purchase the goods, right, you are not directly selling to the buyer or consumer customers, because you are going to hold these stocks for a reasonable time period, right? You are going to store these purchases in your warehouse for a reasonable time period. So the storage expenses, right, there might be a expenses arise, that is storage expenses, that is called here storage expenses. Expenses may arise, that is employee cost, right? Rent for the store, electricity, water, all these are falling under the storage. Okay, these costs whatever the cost rising in connection with the stores or warehouse where we are keeping our trading inventories are called storage costs. That means to the stores we may have an in charge called storekeeper, right? So there may be the assistant storekeeper. We can have so many employee cadres there. Storekeeper, assistant storekeeper, loaders, unloaders, and laborers are used for the stacking the goods. So employees cost also involved. For that particular stores or warehouse, we would have hired or we would have rented out it. So rent we have to pay for that stores or warehouse. Okay, that expenses is there. Electricity charges, water charges, these are called overhead cost. Understood? These are the expenses for storage cost, which is the overhead cost. So these costs are not absorbed into this cost of the unit of good. These costs are not relevant to the, we cannot absorb that as an purchase cost or inventory cost of the unit. We are not abnormal cost in the sense so unusual costs involved, those unusual costs are not taken. So administrative cost, administration work, paperwork carried out by the administration department, the right, cashiers and purchasing officers who are not uh, attached to the stores department, right? They are attached to the administration or purchase department. So cost involved for employee cost or electricity cost or other costs involved for the paperwork carried out in such departments, costs incurred by those departments not absorbed into this production unit cost calculation, right? These are indirect costs, right? These are indirect costs. These costs are indirect costs, not directly involved with the purchases or production. Yes, okay. These are common costs. Whether this production is involved or not, or whether this purchase activity is involved or not, production is involved or not, these costs we have to pay monthly, and this is called overhead costs. Whether the activity is taking place, trading activity is taking place or not, we have to pay the, if you say, very good example, the COVID time. During the COVID time, no businesses were taking place. All the business organizations were shut down, closed. So no business activities are taking place. But having said that, the salaries for the staffs, the companies has to pay, right? The rent for the officers and rent for the business entities, rent for the buildings has to be paid, whether they have carried out the business activities or not. Those has to be paid, right? Electricity, water, right? Those are called Overhead cost in the sense whether you are carrying out the activities or your activities are interrupted or not, you have to incur this cost, right? If you say 1 month time period, right, 30 days forming a month, right, out of 30 days you are carrying out business activities for 10 days, right? You cannot calculate the cost for the administration cost or rent or for 10 days. You have to pay for the those rent for 30 days, right? So that type of overhead cost, whether the production is carried out or not, you have to pay the cost. That is selling cost. So for to the purchased goods has to be sold. Okay, purchased goods has to be sold. For that, selling and distribution department has to involved in these activities. For them, we have to pay some expenses. We have to incur some expenses, salaries and various expenses, pet fuel expenses, right, vehicle expenses, etc., to distribute these purchase goods. Those are overhead expenses. So selling cost also not taken into consideration while we are computing this unit cost for purchases. Storage cost is not considered, abnormal cost not considered, administration cost not considered, right? Please keep it in your mind. These are very important and fundamental as per International Accounting Standards number 2. Sorry, only cost of production should be included. That's what this is, only cost of production. Modification and any other raw material used, if you are adding any raw material, those costs can be taken. And see, for measuring cost, unit cost should be used. If you're going to measure the cost of the purchaser, you always has to go and calculate for the unit cost, right? However, if this is possible, then the benchmark treatments are FIFO and average cost has to be applied, right? However, if this is not possible, then the benchmark treatments are FIFO and average cost has to be applied. FIFO and average cost of production I will teach you little bit later. Okay, disclosure requirements, the accounting policy for the valuation, right? We have to disclose the following in our accounting financial statements, right? Financial statement, it is the requirement, right? The accounting policy for the valuation, what is the accounting policy we have adopted to value our inventories? That is, we have two options, cost and net realizable value. Which is the lower? That investment inventory should be valued lower of cost or net realizable value. Which is the lower, right? Not which is the higher. Lower cost only we are taking. Okay, that is what they says. Whether we are valuing at cost or net realizable value. That's what they say. Number the in D, the inventory total analyze and appropriately. Inventory total should be analyzed appropriately, right? What are the inventories? There's blah blah. That's right. The amount of any inventory is valued at the net realizable values, right? If it is valued at net realizable value, the detail has to be given, it has to be disclosed in the financial statements. The amount of any inventory is valued at, what is the amount of that, right? That has to be. In the next lesson we can do the exercises. So if you once we started doing exercises, you can gradually understand. Okay, thank you. Here we have seen the measurement of inventories. Measurement rule is inventory should be valued at cost, lower of cost or net realizable value. Okay, measurements in lower of cost means the cost of purchases or any modification cost involved and added to this product, and that is the cost of unit, production unit, right? So here measurable of measurement of here measurement of inventory, measurement rule, there is a measurement rule, that is we have seen inventories should be valued at lower of cost or net realizable value, lower of cost minus or net realizable, whichever is lower. Cost in the sense we have purchased the goods, cost of purchase goods, and all the calculation involved modification and bringing that the cost of the inventory should include all cost of purchases. Okay, cost of purchases, cost of conversion, and bringing the inventories to their present location and condition, bringing the inventories to their present location and condition. Okay, that's what this is, the inventories cost involved in bringing that inventory to the present condition and location. This is a modification cost or additions list. So this is the cost, this is the way we have to calculate the cost. Net realizable value in it is net realizable value means estimated estimated selling price minus estimated cost of completion minus estimated cost sales cost, estimated cost of sales, sorry, selling cost, estimated selling cost, that. Okay, net realizable value, this is net realizable, NR, net realizable value, net realizable value is net realizable value is estimated selling price minus estimated cost of completion, right? Estimated selling cost, estimated selling price, if you say we are going to sell for 1000, right? 1000, say estimated selling cost is 200, right? And estimated cost of completion we say 55, 65, 65, right? Then 265 means we will say 265, 35, 635. Sorry, 735. The net realizable value. Selling price is estimated selling price is 1000. Estimated cost of completion as per this estimated cost of completion is 65. Estimated selling cost is we are saying 200. Then if we deduct it 735 is the net realizable value. Cost is 565, net realizable value is 730. Whichever is lower, cost is lower, no? So we are taking the cost, right? Net realizable value is estimated selling price minus estimated cost of completion and estimated selling cost. That is what this is. So cost we have to say. Have you understood? The measurement of inventories, this is measurement rule is inventory should be measured at lower of cost or net realizable value, whichever is lower. So here we have calculated the cost cost of production, unit cost of inventory. Here we are calculating the net realizable value of the inventory, right? Here we are adding our costs. So bringing this into the present condition and location and present location and condition, this is the amount. The modification we are making the cost, that is this estimate. Then total cost is this. The here estimated selling price is the estimated cost of completion. Selling price is 1000. Cost of completion is 65. Here 65. Estimated selling cost is, we assume 200. Right, 200 we are going to involve the estimated selling cost. Then this minus this is 735. So whichever is lower, which one is lower, this one or this one is lower? 565 is lower or 735 lower? 565 is lower. So we are going to take the cost, right? Measurement exceptions. Measurement exceptions. There are exceptions available. Producers of agricultural or forest and mineral products. This is exception for the producers of agricultural. Agricultural products, we are not going to apply this inventory policy, right? And commodity dealers and brokers. Commodity dealers and brokers means gold, petrol, oil, those commodity dealers and uh, oil. This is not applicable as per the inventories in IAS 2 says, right? So there is another part is there, inventory valuation at the end of the year. Inventory's valuation can be two. One is 5 4, right? There are so many categories and so many costs are involved, right? sometimes the we would have our cost for the same X product. We may have X product. Okay, we may have so many products for the sales, right? So we say X product, X, Y, Z. In the January, January, February, February, March, March, right? In the same year, we our cost, product cost, okay, cost X, product X, we would have purchased, our cost may be involved, cost is 100. Here February we would have incurred 110, right? In the March we would have incurred 120, right? For the product Y, we would have incurred 100, 100, 100, right? There is no change. For the product Z, we would have incurred 100, here would have 90, here 110, right? The price, cost of unit, right? This is the cost of unit. For the X product, we have we our purchased our cost of purchases, cost of unit is, for the X product January month we are involving 100 rupees, and 110 on the February, 120 in March. It is increasing. The pattern is cost is increasing bit first 3 months. For the Y, it is stable. There is no change in the cost price calculation and cost price. For the Z, we had 100 and there is a decrease of 90 and there is an increase in 110. So the cost is fluctuating, right? The cost is fluctuating. So there is no certain cost. There is no particular cost involved, right? So in this case, the releasing to the sales, how do we do the sales? How do we issue the goods XYZ to the sales? This is in the stores, stores, right? In the stores, right? We have to sales, for the sales, sales, we have to issue for sales. How do we issue this? Because we have in stock January purchases at the rate of 100, February purchases 110, March purchases 120, right? For this Y, product number Y, issuing not a problem. Okay. For the product number Z, issuing is the problem because 100 we have unit cost is there, 90 unit cost is there, 110 unit cost is here. This is on in January we purchased at this rate, February purchased, we have purchased at this rate. This is on the March. This is on the in the March. So the problem is arise. For that only IAS 2 International Accounting Standards says giving the option LIFO, FIFO, FIFO method, right? Weighted average method, LIFO method. Right? They are giving issuing sales, issuing for sales. First in first out method. First FIFO method in the sense first in first out method. First in is here 100. This has to be sold firstly, right? So once this is completed, we had to go to the February purchases. First in, first out. First in, first out. First in, first out. First in, first out. That means whatever purchases we have done at first has to go out firstly. Okay. Whatever goods coming into the stores at first, purchases at first, has to go out firstly, right? That is the first in first out method. First in first out method. First in first out. First, whichever goods coming in first has to go out firstly. Weighted average method is weighted average method in the sense, you can issue anything, right? So first in first out method in the sense, once we sales at 10, 100 purchase goods will go first, thereafter 110 will go first, and last only the March purchases will go at very lastly. Alright, will go at last. So calculation is, if these two are finished issuing, if we have the stocks March purchase only, number of units into 120 is the cost under the LIFO method. Cost of goods is valuation is 120. Under the weighted average method, we can sell anything, right? Here we can sell anything, but we used to calculate the cost like this: 100 rupees, 110, 120, right? That is 30, 330 divided by 3. Divided by 3. 110 is the average cost. If it is the 1 unit, this is the case. If you have to multiply 100 into number of quantities, and you will arrive at the cost, right? Here number 110 rupees into number of quantity, 120 into number of quantity, and add both things and divided by the number of quantities at the end, right? Here quantity may be 10, 20, 30, we will say 10, 20, 30. Then here 100 into 10 is 1000. 20 into 110, 0, 0, 2, 2200, right? Here 120 into 3, 0, 0, 6, 3600. Okay, 3600, right? Here 1000 plus 2200 plus 3600, then 6800, right? Total cost of the units is 6800, right? 6800 6800 divided by number of units, 10, 30, 60 units, 60 units, right? Divided by 60 units, and 100, and our average cost is 100 and 113.35 33 130.33 is the cost. Under the weighted average method, this is the cost of 60. If we have 10, 20 and 30 under this method, FIFO method, it is, you know, under the FIFO method, 1000, 6800, 6800 is the 800, and here we will issue the inventories, right? Under this method, we will issue the goods at 113 rupees 80 cents. Here we will issue 100 into 10. This is into 10. This is into 20. Right? Cost also say there won't be any difference in the cost, but issuing prices, there will be a changes in the issuing prices. Issuing prices, there will be a change in the issuing prices. Here issuing price will be 10, 110, 120, 110, 100, 110, 120, right? At this rate we will sell to 10, in this rate we will sell 20, at this rate this will go up, right? But the cost will be LIFO means last in first out. Last in first out means we will sell 120 cost of product at first, right? First we will sell, last in first, last whatever product we have purchased at last, maybe we are going to sell it at the first level. We are going to give priority for that at beginning, right? This is not allowed by the IAS 2. International accounting standard is not allowing, it is not allowed, right? Under international accounting standards 2 says you can issue the inventory from the stores on LIFO method or weighted average method. These two are allowed under the international accounting standards number 2. Understood? Issuing inventory issues, how it will take place, costing, how it's take place, we have learned today, right? So I am going to raise this one and going to calculate, do the sum here, 1 2 3 sums, right? So little by little we will learn, so you can understand, right? At that time you can understand this one. Can you this LIFO and FIFO method are used in inventory issues for the sales, right? Because store in the stores, normally if we are purchasing the goods, if we have, for an example, you have product X, product Y, product Z, right? If you have three product, January month purchase price is different from the February month, right? For X it is different, for Y it is same, Z also it is different. Purchasing, the cost of the purchase is different, cost price is different, right? So if it is cost price is different, how do you issue the goods? At what price you will issue? 100 or 110 or 120? That is the problem comes. So first FIFO method, if first in first out method says whatever you receive the goods at the beginning has to be sold at the beginning. Whatever the goods you are purchasing in the beginning has to be sold at the beginning, right? And weighted average method says, say XYZ, take the quantity and calculate the average price of the quantity and take that average cost and do the calculation issuing and the for the costing carrying out the um, closing stocks, you calculate on the average cost basis, right? Both going to have a same effect, right? Same effect, cost is same, there won't be any difference in cost, right? Under the LIFO method, last in first out, that is not allowed. Last whatever the goods came at the end will be issued at the beginning. That is what this LIFO method says. That is not allowed and under the international accounting standards number 2, right? So now stores, how do you issue the goods from the stores which have the different cost in the from the different period? So you can understand how to do this.